Sure, you've got a big number tomorrow with CPI coming out. Where's that going to land for September? You have what's going on in Europe. We've always said this is going to be a bit of a recession situation. It seems like the UK, they were trying so hard to get quantitative tightening going, and they can't. They can't even get that going. And so you look at all of these risks out there, and we just don't think it's time to jump in yet. We think there's a little bit further to go in this bear market, and we think you really still need to be playing defense right now.
AP, I was going to ask you, some are saying that we are set up for a good move higher over the next couple of weeks. But then you get a wrench thrown into the situation like this BOE headline, and you may get more in the days ahead, right? You have a 3-day deadline apparently there for these pension funds to, get their houses in order. And who knows what happens on the other side if they don't. How do we think about that?
It's funny. This morning we were talking about the war in the Ukraine thing, and these headlines should have been worse. So it's like it could be like a negative and a slight positive, and they're offsetting. For sure, everyone knows companies are over-earning. News is going to get worse. There's going to be some bad guidance. The Fed's going to be hawkish. The CPI is going to remain elevated. I think those are basic facts. And I think the question is just, can we get some counter-trend rally into the year end, or is positioning and sentiment low enough to get people excited? I don't think so, to be honest with you. I think we're going to have a pretty bad earnings season and pretty bad guidance. And the stuff we've been talking about the last month or so.
But you think this wall is just simply growing too high to get over? We're going to run into it again with CPI, thinking it's going to show something that it ends up not?
It's just the way that thing works is even if rents start to slow a little bit, you just have so much upward momentum. It takes 6-9 months for that thing to really slow. The Fed's going to stay hawkish. They couldn't be clearer about that. And earnings are going to decline. And now we know there's tons of inventory that's built. Companies overproduce consumption. So I think the main thing is you're looking at 2023 earnings. The street's got 240 plus or minus 241 last. The real number's probably 210, 215. And then I don't even know if that's the trough or not, if 24 is flat or whatever. So I think that what my clients have been asking me recently, the ones who have to own stuff, long-only PMs, are saying, is there anything compared to 2019? Let's just pretend, roll it back. It's October 2019. What looks like, with different oil and different rates, like it's a buy? And there are some companies that you can say, you know what, maybe Amazon's got much more revenue and more cash flow, and maybe if estimates are 10% too high, it's still okay. So people are trying to find your bullish sentiment, but I think they want to wait to get earnings and guidance out of the way and get a better feel for maybe where, earnings could bottom in the next, 12 months.
I mean, Joe, the problem is we are once again, while not making direct comparisons to the dire situation of 08, we're using the words financial stability again, possible systemic risk. That's what David Einhorn was suggesting, of course, the hedge fund manager today in an interview. Systemic risks, he said, have built up in global bond markets. I mean, we are using this language again, justifiably so or no?
I think, unfortunately, we keep having a conversation about, are we going to have a soft landing or a hard landing? The hard landing is here, and it's in risk assets. Forget about the economy. The hard landing is unfolding right now in front of us. Now, I said yesterday with you on the halftime report, if you have a capital need in the next 3 to 6 months, then certainly you need to understand that there's vulnerability, as you stated, to the downside.
Hey, Diamond said it yesterday, right? He used the words. His exact words were, if you need cash, raise it.
Okay, so if you have that capital need, what is unfolding right now is going back to Q4 of 2020. That's when the valuation recession began. The hyper-growth index for the Russell 1000 reached its peak from a valuation perspective and has been in decline since. Now you have this rolling valuation recession, and the last place that it's touching, Microsoft, Amazon, Apple, that's unfolding now. So the next few weeks are going to be very difficult. You're going to need to get a 7.5, a 7.6 on CPI. That's probably wishful thinking for the market to bounce. It's going to be a tough guidance period. But on the other side of that, I'm sorry, I'm optimistic. Because I think if you have a long-term vision, there's enough value that has been restored both in fixed income and the equity market, you're going to be greeted with a great opportunity.
I think it's time. I think it's timing. Go ahead. Sorry.
No, I was going to say Bloomberg came out today saying they're positive, turning positive on bonds. Their rate strategist Ira came out and said, hey, probably be a positive total return on the bonds for the next 12 months. And then you look, it's not all parts of the market. So the inventory buildup, bad for a Nike, but if you look like a Costco who gets to buy that inventory and they're not beholden to any one person, they're buying inventory cheap. So some people benefit. And Louis Vuitton came out today, 20% sales growth. So not everybody is hurting. Main Street, 100% hurting. It's going to be about inflation. It's got to be a U.S. dollar. We're probably hitting 115 again, right? We're probably going to climb back up. Earnings are going to be bad. S&P 500 is about 60% U.S., 40% international. So the Microsofts of the world, those multinationals, they're going to be very hurt.
52-week low today for Microsoft.